I am Paul Johnson. I am the Program Director of the Wharton Online and Wall Street Prep Applied Value Investing Certificate Program. All right, anybody who's followed Apple for more than 5 minutes knows that this has been a monster stock. This stock had, this is a split adjusted, of course, but it started at 30 and it's now well north of 240. That's a big stock. Even over, that's the 10-year chart, even over a 2-year period, this has been a pretty amazing stock. We're going to talk a little bit about some of the volatility in the middle of this chart a little bit later, but this continues to be just an amazing stock. And even this year, the stock is up significantly this year. That little, some of the stuff in the early part of this chart is when Buffett announced he sold. I'll talk about that specifically. All right, this is just some market capitalization data, but Apple was the first $1 trillion market cap company in the history of the world, at the end of 2019. It was the first $2 trillion market cap company at in 2022, and it was one of the first $3 trillion market cap. So this has been a huge stock and wildly successful for shareholders.
Hi there, Andrew from Wall Street Prep, and I assume you're here seeking to gain an edge for your own stock portfolio. Maybe you're an investment advisor seeking to better serve your clients, or possibly an aspiring hedge fund analyst. If that's the case and you're looking to learn something new, then check out our 8-week certificate program by Wharton Online and Wall Street Prep on applied value investing. In that program, you'll have the opportunity to learn directly from Wharton faculty, experienced investors, and industry leaders from the top investment firms in the world. This self-paced program is designed for the working professional seeking to build tangible skills you can put into practice. You'll learn how to analyze company filings, decipher financial statements, build financial models, and how to communicate your investment ideas in a professional setting. After 8 weeks, you'll have earned a certificate from Wharton Online and Wall Street Prep, and you will have had the unique opportunity to grow your network through meetups, invitation-only events, and private LinkedIn groups and Slack channels. And the best part, you don't need any prior finance experience. Baseline accounting and Excel knowledge are all covered from the start of the program so everyone can follow along. So what are you waiting for? Join thousands of others in the next cohort by following the link in the description. Now, back to the video.
The big part of the Apple story is that capital allocation. They have shrunk the number of shares outstanding by 34%, which is rare for any company and especially rare for a technology company. And that's about a 4% decline per year, which is important. And a big driver of the shareholder value has been this. But I'm going to show you there's another wrinkle that investors need to understand. This will probably continue, but keep in mind that Apple is slowed down its share repurchases over the last couple of years fairly dramatically, and they've taken their net cash, which at the beginning of all this in fiscal 2017, they had net cash of 153 billion. They now have net cash of only 50 billion. So a dramatically different balance sheet than we had at the beginning of the story. And I think that's a factor that Buffett looks at. All right. This is a wildly profitable business. The net margin has gone from 22% to 24%. One of the rare hardware-focused companies that have been able to pull this off. We'll talk a little bit about the return on capital and the relationship of Foxconn, important in part of this net margin. Probably hard to think about the margin expanding from here. If anything, it's trended down the last couple of years. I'm going to show that specifically a little later. As the company, I think now is worried about growth, particularly growth. And I think what we see is stories of them investing more in R&D and sales and marketing. All right, return on capital for this company is off the charts. It's so high, in fact, we sort of have to make some adjustments to the reported numbers. They have negative net working capital. It's an inverted balance sheet, one of the great mechanisms. Think about that. People pay for their Apple product within 3 days. MasterCard settles within 3 days, American Express 3 days, and then Apple can stretch out its payables, obviously. So this return is just on property, plant, and equipment. Now, in fairness, if you look at their working capital, you argue that some of the sales and marketing and some of the R&D probably should be capitalized, which we can do because if you and I wanted to get into the business to compete with Apple, we'd have to build more than just a fancy headquarters in California. We'd have to spend a lot on R&D, a lot in sales and marketing. So you might want to capitalize that, which I'll do in a moment. But if you look at it, this is just looking at the components of the return on capital. Scale is on the left. That's their biggest driver, but they also have very impressive NOPAT margins. Look at this as scale. Scale is defined as the dollar of revenues generated for a dollar of invested capital. And for a company like Apple, this is off the charts. This is unbelievable. This is more of a distributor type company that has high revenues, low margins. Apple has high revenues per capital invested and high margins. That's why the return is so impressive. But here is, their annual operating expenses. I've broken out R&D and sales and marketing just so you could see it. And then I went through the exercise of doing a 3-year capitalization. Just capitalize R&D with a 3-year life, capitalize sales and marketing with a 3-year life. That increases your invested capital dramatically, obviously, because you've now taken some of your operating expenses and put them on your balance sheet. You still have a very impressive operating business, although the margins have come down. If you do that, margins come down a little bit. The business has gotten a bit less profitable. Obviously not a big deal, but something to at least note. And then the return on capital, if I capitalize some of those expenses, just suggesting they have a longer life than the 1-year expense, the return on capital comes down, to an extremely healthy percentage, but obviously much lower than when we don't capitalize any of the operating expenses. All right, and this I do think is important, that the adjusted return on capital has been coming down in the last few years. They got a big jump in 2021 from COVID. I'll talk about that on the product side in a moment. And since then, we're coming back to kind of where the returns were before the big increase in demand during COVID. I suspect this continues to trend down a bit. Again, another factor that I think Buffett's looking at these sorts of things, frankly. All right, but the key to understanding Apple's profitability and return on capital is clearly their Foxconn relationship. And Foxconn is, as everybody knows, their primary manufacturer of products. And it's fascinating when you go look at Foxconn, because Foxconn is a business. This is all in reported numbers, but this is in US equivalent. Foxconn has invested capital of almost $80 billion, which is twice the stated invested capital that Apple has. This is in USD equivalent, and their return on that 80 billion, 77.8 billion is about 6%. So it's sort of fascinating to me that Apple, given tremendous credit for this, and Tim Cook specifically, has convinced another company to invest $77.8 billion at a 6% return. And I doubt Foxconn's cost of capital is below 6%. I don't know what their capital structure is, but highly unlikely that they can have a cost of capital less than 6%. So even if it's 6%, Foxconn has invested almost $80 billion at a return equal to their cost of capital. So fabulous on Apple's part. I don't know so great on Foxconn's part, neither here nor there. All right, so let's talk a little bit about Apple's competitive advantage, because this is critical to understanding the duration bet that Warren Buffett made back in 2015, 2016. Now, competitive advantages in my world, some people may disagree, come in 3 flavors, and I've added a 4th for Apple: customer captivity, production advantages, scale, which they clearly have, and then I think brand, but it's aspirational brand. And so if we look at Apple, customer captivity, switching costs are extremely high. I think it's very difficult for very few people go from Apple to Android. You get a few people going from Android to Apple, but the switching costs are extremely high. And I think Buffett understood that. It wasn't really a technology company that way. It was a long duration business. Production's been outsourced. Scale, they definitely have scale when it comes to distribution, sales and marketing, R&D. We just talked about that. And then aspirational, there is brand value. It's a cool brand. So Apple's competitive advantage is as strong as any competitive advantage I've ever seen. They have an obsolescence challenge over time. They're in a market that's not growing very fast, but their ability to hold on to their customers is significant. And as a consequence, they charge high prices. They have very profitable business and very high return on capital, as we talked about. All right, so this is something we call the Italian cookie. I'm going to go back to it. It's the 3 layers of value that a company has. First layer is red. That's the invested capital. As you see at Apple, they have almost no invested capital. Layer 2 is the excess returns from high return on capital. That's your competitive advantage. Refer to that layer as the present value of competitive advantage. And that's where all of Apple's cash flow reside, in those excess returns. And then you have this third layer called the market implied value of NOPAT growth, which is the difference between your earnings per value and your enterprise value. And in Apple's case right now, if you look at the lower table, I'll highlight that. That's the Italian cookie. It's about 69% of their value today is based on investors' expectation for future NOPAT growth. So we really have to think about where that NOPAT growth is going to come from. And I'll show you that. So that's your final layer. All right. If we take, I'm going to go back a couple of slides. We're going to take this table, which has the 3 layers of value: invested capital, present value of competitive advantage, and then your market implied value of NOPAT growth. And just take these numbers and put them into a chart so you can take a look. Blue is the present value of competitive advantage. That's their annual cash flow, almost all of which comes from excess returns. If they had any risk to their competitive advantage, that blue layer would be at risk. And then green, the market implied value growth, is what investors are assigning to future NOPAT earnings growth in the future, right? So you can see that the green, market implied value of NOPAT growth, is actually very high. Investors today are betting that Apple will be able to grow in the future. So the whole challenge is, can we pull this apart and see what investors are thinking, what triggered Buffett in his decision, and is that assessment reasonable? All right, so there's the enterprise value. We saw this before in a stock chart. You can see a significant increase in the enterprise value. This effectively is the stock. Now, we're going to have to adjust this for shares momentarily, but that's that market cap we were talking about. This is nothing more than that stock chart, but in an annual bar chart. All right, so here's Buffett's initial purchase, close to the end of 15 and into 2016. The market cap of the company is order of magnitude, $700 billion. All right, now here's a little formula that you can use. I like it. The implied return in any stock is equal to the cash yield plus the growth, if you can assume that the company is going to have a constant return on capital, a constant competitive advantage. Another way of saying this is a constant PE. All right, so in 2015, using this formula, the implied return, the NOPAT cash yield, was 7.5%, incredibly low. And I think that Buffett was pretty confident that the company could grow its NOPAT 3 to 4%. Now remember, this is a very profitable company. Hard for them to expand their margins much, operating margin. So the NOPAT growth is going to be driven by revenue growth. And I think that most people think they're in a growth market that 3 to 4%, probably the handset market. We'll talk about products versus services in a moment. So if you add those together, you get an implied return of 10.5 to 11.5%, assuming management does something productive with that cash flow. I think Buffett was very confident that Tim Cook was going to return that capital to shareholders through share repurchases. So this is what Buffett was looking at, a 10.5 to 11.5% return. And I think he thought that was very good. The only assumptions he had to make were 2. One, that the return on capital would stay constant, which is effectively saying that Apple's competitive advantage would hold, and management would do the right thing with cash flow. That's the only assumption he had to make. I think he was looking at an 11% return, and he said, yeah, not a problem. All right, we'll come back to that. Now, when he owns the stock, the enterprise value triples in the first 6 years. Pretty amazing. I don't think he was betting on that, but he was happy to see it. And because the shares outstanding have declined so much, we really have to look at everything on a per share basis. So if you look at it from that perspective, he was looking at enterprise value per share of about 31, and that went up almost 8 times in 8 years. Now, if the company had generated all of that incremental value through operations, I think Buffett would still own the stock. But you'll see in a minute that a big chunk, arguably most of the increase, is actually market implied value growth. Investor expectations have gone up dramatically in that period. And I want to show you what that looks like. All right, so there's your earnings power value. That is essentially NOPAT capitalized by the cost of capital. I'm using 8% to make the math easy. And what you can see here is there was not much of an increase in the earnings power value of the company for the 5 years that Buffett initially owned it. So the operations did not increase just on a nominal basis much at all. In fact, it's a fairly nominal growth, which is what I was concerned about back in 15 when I first saw that investment, the announcement by Buffett. I thought, this isn't going to grow much. But because of the long duration of the business, the cash yield is still potentially impressive. All right, then COVID hits, and I don't know about you, but I upgraded all my hardware. When it was clear that we were going to be working from home, I upgraded all my computers across the board. I'm bilingual. I do Mac and IBM, or the old IBM, Microsoft. And so I upgraded all that, and a lot of other people did upgrade my phone, upgraded my headset, I mean, the whole thing. And you saw a dramatic increase in revenues and profitability of Apple. But post-COVID, we haven't seen any growth on a nominal basis. Now, again, we have to look at earnings power value per share. Now, earnings power value per share increased 2 times while Buffett owned it. And it was really, remember, earnings power value did not increase, but earnings power value per share did, because the company was deploying capital, which was really Buffett's guess, by buying back stock. So earnings power value per share doubled in the first 6 years you own the stock. And then because of COVID, we saw a dramatic increase in not only the earnings power value, but the earnings power value per share. And it went from 2 times to 3.5 times by adding 1 year. It was up 67% in 2021. And post-COVID, it's jumped a little bit in 22, but it's effectively flat to down since post-COVID. So they're not growing the earnings power value, and they're not buying as many shares back. And oh, by the way, the dollar volume of shares buying back, which is about 25 billion a year, is significantly less because the valuation is so high. So what Buffett saw in 2015, 2016, I think is very different than what he saw today. All right, so as I said all along, the real increase in the value of the company, the share price, has really been the market implied value of growth. Here's the nominal amount. Here's that same amount. The light blue, I'm sorry, the light gray here is your earnings power value. If I strip out the earnings power value and just isolate the market implied value growth, you can see a dramatic increase from when Buffett bought it. And in fact, when Buffett bought it, the stock initially, he was paying nothing for growth. I don't think he thought there'd be a lot of growth. There wasn't a lot of growth in earnings power value. There was a lot of growth in earnings power value per share. And I think Buffett just said, I'm not paying for growth. I don't anticipate much growth, but I do think that this is a long duration business. My implied yield's probably 11%. And I think management's going to do the right thing with the excess cash flow. That was the right call. He nailed that. I don't think he ever thought he would get rewarded for growth. So interestingly, the value of the company has increased dramatically, but a big driver of that is market implied value of NOPAT growth, which is expectation. So investors are willing to pay more today for NOPAT growth in the future than they ever have. This is a record in terms of dollar amount, as you can see. Now, that's increased 25 times in 9 years. I think Buffett's looking at that and thinking, this is a very different story than when he bought the stock. Now, if you look at market implied value growth per share, because the share count's come down, that's increased 40 times in 9 years. So investors have been rewarded up to this point. You got the COVID bump, but other than COVID, you haven't had really any growth in earnings power value. Not surprising, they're in slow growth market. But what you have seen is what investors are willing to pay for future growth has increased 40 times since Buffett bought the stock in 2015, 2016. This is your market implied value growth as a percentage of enterprise value. You can see that this is also as a percentage at a record in 2024. I repriced this the other day. So it's the highest percentage you've ever paid for future growth. certainly in the 10 years that I tracked the company closely. All right, so there's Buffett's initial purchase. He's paying almost nothing for growth. And that green part as a percentage increase is threefold. Pretty amazing. Buffett announces at the annual meeting that he sold 10% position in his permanent holding in Apple. And this is when I was driven by, I did a little YouTube video that said, I suspect more selling's coming. There's a dramatically different investment today than when he made the investment in 2015, 2016. And this is not lost on Buffett. All right, so Buffett sells his 10% position. He announces it at the annual meeting. He sold that 10%. Stock sells off, as you would suspect. And then the stock comes roaring back. And that part is fascinating to me. As the kids say today, let's put a pin in that. I'm going to come back to that in a few slides. All right, so then we announced Buffett sold another 50% of his stock a few months later. And guess what? He sells 50% of his stock and the stock continues to go up. And this is kind of amazing to me because you have a couple of things. The company doesn't really grow its earnings per value. It does on a per share basis, but their repurchases have slowed dramatically and they're having less of an impact because the dollars don't go as far. Buffett, who is certainly one of the most respected investors around, made a gazillion dollars in this investment. He's basically selling the whole thing off and the stock goes higher. And you would think that that would be an indication to everybody that, hey, maybe something's changed in the stock. Investors have interpreted it very differently. Fascinating. All right, let's go back to the implied yield. The implied yield right now is 2.5% no-pack cash yield, down from 7.5%. And I think you still probably want to believe in 3 to 4%. So Buffett's now looking at an implied yield of 6%, not 11%, with, I think, significant valuation concerns for the same company he was buying 10 years ago. I don't think much has changed in Apple's position or Apple's growth opportunity. At the same time, valuations increased dramatically. Almost all of that increase has really been driven by investor expectations for future growth. So I think in that sense, Buffett's like, I'm not so sure. All right, so there's your no-pack EV cash yield. Started at 7.5% when Buffett bought it. We're down to 2.5% now. Keep that in mind. This has become an expensive stock. Now, here's Buffett's purchases. A lot of purchases in 16 and 17, a little bit of trimming along the way, bought a little bit more, interestingly, post-COVID, and then he's basically been selling I think he'll sell all of his position. Here's his aggregate holdings. You can see we peaked in 18, and then now we're down dramatically. And I think soon it will be all gone. All right, so here's your market implied value no-pack growth. I think this is really what Buffett sees, and I think this is what Buffett's concerned about. The S&P 500 right now is about 64% market implied value no-pack growth. The S&P 5-year average is just under 50%. So we have an expensive market, and we have Apple trading above the S&P. It's probably a better business than the S&P, but less growth than the S&P. All right, now here's another formula we'll talk about in the certificate program, which is you can actually tease out what the long-term growth rate is for a company, and you just take the market implied value growth as a percentage of enterprise value multiplied by your discount rate. I don't have time to go into all of the details. It's kind of a fun little formula. And so right now, the implied long-term perpetuity, that's what you're getting, is a perpetuity growth rate of 5.5%. So I want to dive into that for a moment and see where that's going to come from, that 5.5%. All right, there's their revenue. This is Apple's annual revenue. You saw a little bit of growth pre-COVID. You had a lot of growth into COVID, and since then, sort of flattish, right? So there's your annual growth rate, there's your annual growth rate. And so if 5.5 is our target, they're not growing at 5.5 right now, and 5.5 is your perpetuity growth rate. So that's not just short-term, that's the long-term growth. All right, there's your product revenues. Product revenues they did almost nothing pre-COVID. You see some product cycles in 15 and 18. You get the big bump in COVID and then coming out of COVID. And then since then, you've been flat to slightly down. That's product revenue. Now, service revenue is definitely a very different story. And the service revenues increased fairly dramatically and continues to grow important growth rates. However, it's important. Two things are important. It's still a small percentage of revenue, and I'm not sure it's a better business than the hardware business. So we do have a mix issue here to keep in mind. All right, so this is services. If we index back to when Buffett bought the stock, services are up 500%, a little bit over 500%. Product is up 80% over a decade. So you can see services are clearly the most important growth driver at this point. But if I look at percent of revenues, your iPhone is still over 50%, and it hasn't shrank much. Now, services have increased, but the iPhone is still the dramatic part of the revenue. So overall, Apple's future is really dependent on their iPhone sales more than anything. And keep in mind that Google pays Apple's $20 billion each year to be their search engine provider, which I think is fascinating, which is pure profit. So let's not forget about that. I don't have any insight if that lasts forever or gets cut at some point. But Google's happy to pay Apple $20 billion a year to have those Apple customers effectively go through the Google search engine. All right, and then if we look at rolling 4 quarters, this is iPhone as a percentage of product revenue. It's actually up over time. There's been some talk that Apple will diversify their products away from the iPhone. We've yet to see that. We'll talk a little bit about that. And then here's your product growth rate year over year. This is just pure year over year. You can see COVID, the big COVID bump, but since then we're not growing much. A little bit of a bump, new product introductions in the fourth quarter of 22, but since then not really much product revenue. Remember, that's our market-implied no-pack growth, 5.5%. There's your product growth. I don't know, maybe a couple percentages. So if I just put the product revenue growth and the market-implied in one chart, you can see that that's not an insignificant hurdle. Services will be part of that, but still product is over 50% of revenue. All right, so this is their profitability. Again, I just want to come back to that. Probably hard to argue that profitability will expand, which means that the growth in NOPAT, the growth in earnings has got to come from revenue growth. It can't come from profitability. Unlikely it'll come from profitability. Now, I will tell you that the phones they introduce are magic. Unbelievably impressive. In fact, if you had left the planet and you came back and you picked up an iPhone 16, you would think that this is magic. It's unbelievable, the sophistication that they bring to these products. Just amazing. But keep in mind, they have to do this every year. They're on a treadmill. If they were to miss a product cycle, I think that would wreak havoc to the overall product. Over time, it probably wouldn't affect much. So this is a treadmill. These products are magical, but they're also required a new one every year to keep people upgraded. This is an upgrade business primarily. Now, cumulative R&D since Steve Jobs passed away in 2012 is $200 billion. I'm always fascinated to understand where is that $200 billion gone into. Now, no question that the AirPods are, I guess they're the little buds, great business. It's big enough to be a Fortune 500 company by itself. They've brought all their silicon in-house, which is probably a good thing. So they spent a lot of money on microprocessors. And then you have the watch. But beyond that, it's not a lot of new innovation. Johnny Ives and Steve Jobs were probably the greatest innovation duo in the history of technology. Tim Cook is an operating guy, impressive operating guy, extremely impressive operating guy. But it's hard to point to that growth driver that we're going to get from the Apple products. Now, they introduced this. They had 200,000 pre-orders sold on the introduction. That's 700 million in revenue, by the way, not insignificant. They're going to shut down production at the end of the year. So that's not going to drive it. Wearables, by the way, are almost exactly where they were 5 years ago. So that's probably not going to be the driver. Now you have an incredibly impressive installed base. So there's some optionality. There was a lot of rumors about the Apple Car. They were going to introduce that into a market that is very crowded. It looks like they killed that earlier this year. So we're not going to get a car to drive it. Then this year we introduced Apple Intelligence, which I think the goal is really to sell hardware, really encourage people to upgrade to the iPhone 16 rather than, it doesn't look like it's going to be a product revenue source by itself. But I think it's really to kind of force the upgrade to 16, 17, and 18, the devices that are coming. By the way, the stock did pop on that announcement, so it certainly worked from that perspective. But when things like this happen in a stock, all you're doing is seeing that movement move into the market implied value growth. It's just greater growth expectations in the future. And as we said, Buffett sells 10% of his position, and it's announced in May. Stock goes down. That should be a negative signal to other fundamental investors. And then the stock rocks up. He then sells 50% of his business. Remember, that was his initial purchase. That's his 50%, dramatically different market cap. Somebody's bigger, but the real growth came from COVID, not anything else. That's the key. So he sells 50% of his position and the stock moves higher. That too should be a negative signal to investors. But here's the key insight. This is what's going on in the market unrelated to Apple, but it affects Apple. And it's important for investors to understand is your enterprise value increased 5.3 times in 9 years, right? Really impressive, creating a positive feedback loop for passive investors, right? So the index weight of the top 7 companies in the S&P 500 have grown over time. It's now at a record. This is the only statistic I could have. It's bigger now, but it's 28%. So we get this effectively a positive feedback loop for passive investors. Fundamental investors might look at the valuation, as I think Buffett has, and said it's hard to justify an investment in Apple based solely on the fundamentals. But because the top 7 companies, the Magnificent Seven, are now grown as a percentage, and Apple's market cap continues to grow, it creates a positive feedback for passive investors, both ETFs and mutual funds. And by the way, active ETFs and active managers that don't want to fall behind the benchmark. People are owning Apple because of its position in the S&P, not because of their fundamentals. And Buffett doesn't have that constraint. No one is looking at his portfolio versus the S&P. He sees a lot of valuation risk, I think, and maybe if he understands this passive thing, but it looks like this is going to continue. I don't know what's going to slow it down. But here's the key. Here was a paper published a couple of months ago that they went and they looked, clever academic paper, where they just stopped and said, who sells when passives buy? And at the end of the day, it's firms that are issuing stock into the passive market. So the passives are controlling a big chunk of the market, at least incremental. Flows into passives probably continue forever. And so this trend doesn't walk away. But every time Apple is buying back stock, they're competing with the passives. And so part of what's really driven this stock is passive buying while Apple's buying. And as Apple shrinks the share count to maintain that percentage, the passives have to effectively buy more. Where that shows up is on a fundamental basis in a market implied value of growth that expands. So from a fundamental perspective, we really have untethered, I think, Apple stock from the fundamental performance. It's now really being controlled by the passives. Really important to understand. So as I look at this, market implied value of growth only goes up in a company that doesn't really grow. It's not clear where their next growth vehicle will come from. We see this expansion of green, an untethering of the market cap to the fundamentals. And I think for somebody like Buffett, who doesn't care about relative performance, he looks at it and says, that's too much valuation risk. Now, so the next question is, who's going to buy if the passives ever have to sell? So this is this paper. They came and they said, in both the short and long run, firm companies take the other side of the positive passive demand shocks. That allows companies to issue shares either through options or through actual direct listing. Passives take up all that volume, which is fascinating. Lots of really weird case studies I won't go into. Now, the question is, if passives were ever to sell, who's on the other side of the trade? And it's small institution and retail investors take the other side of the trade. I would say the value investors. So I don't think the passive thing, I'm not an expert on this. I don't think that that trend moves, changes anytime soon, but you do see this, I think, potential untethering of Apple's valuation from their fundamentals. And so you do run the risk that if there was ever a investor shock in Apple, your cover bid, that next bid, is going to be a value investor. So I wanted to look at that for a moment, right? So the key here is that's going to be the other side of the trade. All right, so this is Apple's market implied value of NOPAT growth. This is their market implied NOPAT growth with the appropriate growth rate. So if you're using 3 to 4%, guess what? The dark green is what the market implied value growth rate should be. And then the light green is speculative growth rate. And you can see that. So I'm toggling between the two. Here, the dark green is what market implied value growth should be on Apple. And it would bring the valuation down to less than $1.5 billion. This is that speculative growth rate. If you look back when Buffett bought it in 15 and 16, there's negative speculative growth. The company trades below its nominal growth rate. But starting in 19 all the way through 24, what's really driven the value is the speculative growth rate. And so that's the key. So now if we do it as a percent of the implied growth percentage that is kind of appropriate with now the speculative growth, so 55 roughly, I'm not trying to imply exact precision, but more than 50% of today's value is really speculative growth, effectively. Now, as long as passives are buying, I don't think it matters. But if you ever had a reversal in Apple stock and we had to trade where it, quote, was a more attractive fundamental investment, the stock could be down 50 or 60%. And if it overshoots, as we kind of settle out sellers and buyers, it could be down even more. Now, I'm not making this as a prediction. At no point is this an investment recommendation. Probably should have said that up front. I'm just giving you some analysis. And I think Buffett sees this chart and he just says, I don't want to take the valuation. Now, passives probably continue forever, so it doesn't matter. But if it ever did matter, it is quite possible that Apple is overvalued significantly. All right, I think that's at risk. That's the end of the formal presentation. I went through it very quickly. We have time for Q&A.
All right. Thank you very much, everybody, for submitting your questions. I'm just going to go down through the ones that have come in through the Q&A box. Paul, the first one goes for the Italian cookie analogy. What is meant by the red row invested capital when I think you might have said that Apple has no invested capital?
Yeah, it's let me talk about the Italian cookie generically, and then let's talk about it specifically to Apple. So there's 3 layers of value. The first layer is invested capital. The second layer is excess returns. When you add those together, you get earnings power value. Another way of saying it, earnings power value is composed of invested capital and a layer that may exist of cash flow from excess returns. The next layer is your market implied value of growth. That's investors looking forward, what they believe the company, what they're willing to pay for the company's NOPAT growth, earnings growth. And then when you add earnings power value and the market implied value of growth, you get your enterprise value. Flipping that on its head, enterprise value is composed of 2 primary pieces: market implied value of growth, future growth expectations, and earnings power value. Earnings power value is composed of invested capital and your excess returns. All right, let me talk about earnings power value for a moment. We use invested capital as a proxy for essentially an economic book value. Another way of thinking about it, the cash flows that support the necessary capital charge, if you capitalize those cash flows, they said a lot in a sentence, you get the invested capital. It's a circular formula. And then if the company is earning a return on capital greater than their cost of capital, you're gonna have excess returns. And if you capitalize those excess returns, you get the present value of competitive advantage. That blue layer is dependent on the company's ability to defend those cash flows in the future, to defend that those excess returns, which means that the company has to have a sustainable competitive advantage. It's got to be some sort of barriers to entry. That's that earnings power value, light blue. The green then is investor expectations of future growth. All right, Apple, you have almost no invested capital. Much of the invested capital is at Foxconn, to be honest. And therefore, because they have such high excess returns, they have a very, very wide blue layer, present value competitive advantage. And I think Buffett feels, and I think he's probably right, that was really what he was paying for. Remember when he bought it, there was almost no green. He's just buying that earnings power value. And his bet was two things: that the duration of that competitive advantage would last for a long time. I think he's right. I think he was right then. I think he's right today. And that management would take those cash flows and deploy them in the best interest of shareholders. And both bets came true. But then what we saw was the market implied value of growth went from essentially less than 20% to now where it's over 60%. I don't think he thought that would happen. And I think now that it's happened, I think his concern is whether or not that is sustainable. And his, I think, concern is that the implied yield at this higher valuation is not attractive, which is another way of saying he thinks that there's some valuation risk. I think he would rather own cash.
Hey, Paul, this is Brett. I had a great presentation. I had a question.
Yep.
To what degree do you think Buffett is learning from his past investments? I mean, I was just looking at Coke, for example. You know, Buffett turned $1 into $20 at Coke in the 80s and 90s and early 2010s, but over the last decade, the valuation got extended and it's underperformed by nearly double digits per year for the last 10 years. Has there been any signs that, you know, he's using pattern recognition to understand that, hey, there's a time to own great companies, but the extended valuation actually presents more underperformance risk? Or if you're sitting there, you know, trying to get inside Buffett's mind, what do you think what are the lattice work of historical trades that you think he's bringing to bear in his decision making here?
Yeah, I think great question. Buffett has said, he framed it really well. Buffett has said numerous times that he probably should have sold Coke a long time ago. And I think he regrets that. But I think he was also caught up in this idea that I want to own these things kind of forever, because then when I go talk to managers to sell me their business, I can say I never sell anything. This is always a great home, which is slightly disingenuous because, like Dexter's shoes, he just let it go out of business instead. So I think that there is an element of, hey, we should have sold Coke. The implied return at the top was uninteresting, and we probably should have sold that. And so I think you've connected the dots well. I think with Apple, he's more concerned about the duration of the business. Although ironically, you know, Coke's business in many developing countries is shrinking. They've been forced into less profitable beverages. So I do think there's some analogies here, and I think the way you framed it, I hadn't thought of it. I suspect there is a connection.
We've got another question, which is, how did you come up with a 3 to 4% assumption for NOPAT growth?
Great question. And if you have a different number, that I gave you the formula, you can put in your own number. I say that they're 24% operating margin, and unlikely that's going to 28%. If anything, it probably trends down a bit because they have to spend more. So any earnings, NOPAT growth has to be revenue growth. So then revenue, we've got two primary drivers, product and services. Services looks like it's double digit, but not as good a business. So it's, I don't have the numbers, but I suspect the contribution to operating margins is less than the hardware. So I've got services growing faster than the corporate average by far, but potentially a less good business. And then I look at product, and product is the end market of product is a replacement cycle. They're in a very mature market, primarily handsets, computers, iPads. Those are all mature markets, mostly replacement markets, and the replacement cycle is stretching out, not coming in. I don't think they have much to accelerate that. So when I kind of throw all that together in the blender and I put it together, I come up with 3 to 4% revenue growth. Margins, I'm willing to say, are going to be flat-ish. And so that's how I get the NOPAT growth at 3 to 4%. Now, you may, there's arguments on either side of that 3 to 4%. I think there are more arguments lower than that, but and you really do have to work through services and what that product. If you take the Google contribution out, the services business may not be as good a business as people think it is.
Got it. We've actually we've got a question from Robert Hagstrom, who asks, setting aside growth expectations, how do you think about Apple's valuation adjusting for ROIC? The market sells at 22 times forward estimates with a 15% plus or minus ROIC, whereas Apple's ROIC is 200%. What is a slow-growing 200% ROIC company worth relative to the market?
Yeah, now, look, Robert, I'm delighted you took the time to listen. Thank you. I'm very flattered. I think it's the wrong frame. I think at the end of the day, I'm a big believer, man with a hammer. I think everything is cash flow. I think price to book is all about cash flow. I think everything's about cash flow. What you have on Apple is an asset light business. So the good news is that incremental investment in return in capital is negligible. So it's really the notepad is almost all true free cash flow in this business. And I think that's the right way to think about it. Whereas other businesses that are more capital intensive, lower cost, lower return on capital, part of that notepad, that the operating cash flow is going to have to go to reinvest in the business. Whereas Apple has almost de minimis reinvestment in the business. They built a fancy building, but other than that, it's really almost all their capital spending is short term. It's all office type related stuff. They have no factories. So I think it's better to think about it is the components of the operating cash flow that have to be reinvested in the business. Higher return businesses mean that there's less reinvestment need, and therefore that cash flow, the reported cash flow is closer to the true free cash flow, distributable free cash flow. I think of it more that way. And in that case, then we're back to cash flow.
We've got a question from Juan who asks, what do you think stopped Buffett from selling in 2020, where the implied notepad growth jumped from about 30% to about 50%, which is clearly a speculative signal, and even more to remain a holder at those levels for 3 to 4 years after?
Well, a very good question. I like this question. It might, Brett's question may be part of it, that this has been going on now for a little while, and he says maybe now is the time. But do keep in mind, in COVID, we saw an enormous amount of growth. I think it was a upgrade cycle, a massive upgrade cycle. And I think Buffett, I don't think anybody at the time knew whether that was temporary or maybe a new growth projectile for Apple. A few years later, it's now obvious. Well, obvious. Careful with that word. It sure seems like that was a massive upgrade cycle rather than a new growth trajectory. So I think it's quite possible that Buffett just post-COVID let this sit for a couple of year or so, year and a half too, and he finally looked at it and said, wait a minute, we're back to the old Apple, no growth. The COVID thing really was a big, massive upgrade cycle. That's my take.
Great, and we've got another question, which is, one question is, do you think that there are any other businesses that mirror what is going on at Apple?
Great question. I've not done the work, so I'm not sure. You've got the passive part, which is really function of market cap. So you want to, if you're going to go do this, start with the largest market cap companies and go down. The difference between an NVIDIA and an Apple is NVIDIA has got explosive growth. Now, interesting, NVIDIA is a really good case and worth looking at with the same tools. Market-implied value growth's actually come down because I think investors are unwilling to believe the current growth rate will last forever. But you've seen this massive increase in earnings per value. So if you mirror the two, which I do in class, I mirror those two, Apple and NVIDIA. One is you've got NVIDIA in my mind is fascinating because you've got explosive growth, but the duration of their competitive advantage isn't anywhere close to Apple's. In fact, I would argue their duration of competitive advantage is quite limited. And the market-implied value of growth in the two companies is similar. It's a little bit higher in NVIDIA. It's about 75% versus 68%. But you've got one with an incredibly long duration business. Apple, enormous competitive advantage is no growth. And you've got NVIDIA, you've got enormous growth, unsustainable growth, probably, these rates. I mean, that's not the hard thing to say. And, a much more fragile competitive advantage. So I like pairing the two for the students so you can see just the difference. They have somewhat similar valuations. And I think that's, to a larger degree, passives are influencing both of them. The difference is Apple, because I don't have much growth in the fundamentals, I can really tease out the influence of the passives, whereas on NVIDIA, it's a little bit harder.
Turning back to the slide of the market-implied value of growth, Could you please explain how to derive the speculative growth percentage and the implied growth percentage?
Oh, sure. It's right here, so it'll make life easy. All right, that's the overall market implied value growth. And so what I've done here is, and I'll explain it, I'm just explaining what I've done, and then I'll give you the quick formula. I've created what I think is the correct implied growth rate versus the speculative. Now, I gave you a formula. So growth is the market implied value of growth divided by the enterprise value. So the percentage of the company that is represented by growth times the discount rate. All right, keep that in mind. We can work backwards. So if you think that you know what the growth is, 3 to 4%, that's my number. I use 3.5, and work the other way, then you can actually get what the market implied value of growth should be as a percentage. And so I did this. I used this formula. It's on the screen. We'll go back to the very end. And I just did it backwards. I just stopped and said, I think at 3 to 4% is the correct amount, which then means that that green percentage, let's do it as a percentage easier. The green percentage works out as 3.5 divided by 8%, says that that should be 44% essentially. And so the light green is the implied growth at 3 to 4% at an 8% cost of capital using the formula that's no longer on the screen. And then you just subtract from that what the market implied value growth is. And that's how I did it. And if you have a different growth rate, you think they can grow faster or slower, you can do the same formula. Just do it reverse, and then you can calculate the two components.
We had a pretty interesting one on the capitalization of operating costs. Specifically, what framework do you use, or is there a framework you use for how to decide what operating costs to capitalize into invested capital for the purpose of the analysis you shared?
Yeah, I would say at best, this is art, and probably black art at that. Greenwald always said, he had some rule, 5 years or something like that. No one knows. The logic is that R&D, the way we do it now from all companies, almost all companies, some software gets capitalized, is that we just expense the entire R&D in a single year. Well, if the R&D is constant every year, then that's somewhat the same as capitalizing it. But if R&D is moving around or growing, then you want to think about putting it on the balance sheet and then taking it off the balance sheet. So you're amortizing. I did 3 years just to show that the returns come down, but still are really impressive. It's pretty easy to set up. If you want 5 years, you just have to have enough history. You got to go back 15 years to have a good series. I have a model, a very detailed model that's 11 years old, 12 years. And so 3 years worked very well. I could get a nice series out of it. And I was just trying to demonstrate it. Sales and marketing is similar. There's a lot of brand development, a lot of aspirational development around the Apple brand. We expense all of that in the year that they incur it, but you could argue that some of that has a useful life of more than a year. So you capitalize it, then you have to decide, capitalize it every year, and then you have to decide what's your amortization schedule. I use 3 years again for that. There's nothing magical about 3. You could use 2.5, you could use 5. I don't know, use 7. Once you set it up, it's pretty straightforward. And the value is really more of as a point to be made as opposed to deep analytics, because we don't know the correct amortization schedule. How many years should we amortize this over? Once it gets going, it doesn't move things around that much, except it does inflate your balance sheet, makes you a bit more profitable, but increases it. So you can, it's probably closer to what the return on capital would be for Apple. Now, I didn't show it here. I had to limit the slides to something. But I have another analysis where I smushed together Foxconn and Apple. Just take all of the Foxconn invested capital, put it on the Apple balance sheet, take the profitability of Foxconn, put that on the balance sheet, and the returns obviously come down as well. It's about, in that model, it's about 60% Foxconn, 40% Apple capital. So if you just weight the two, the return on capital is still really impressive. I think I got something in the 60s. So even if you include Foxconn in the Apple balance sheet, you're still getting a very impressive return on capital. The difference is that Apple gets to keep all of that and Foxconn gets none of it. Excess returns anyway.
Here's actually kind of an interesting one, which is if you could point out a punchline of the presentation, what's one you would want us to remember?
I think the most important part is that passives seem to have, Michael Green and a few other people have done a lot of work in this area. I certainly defer to him, but passives are driving these big cap stocks. And as long as that game continues, you're probably fine. But it appears that unless Apple can figure out a way to grow, their overall valuation is untethered from their fundamentals. And so you're really, if you own Apple today, you're betting on the passives continuing. It's a passive bet, not on a fundamental bet. And I think that's the takeaway, is that, and Apple's the only one in the Meg 7 that's not really growing. So it's the one where we can really isolate this passive influence, this passive control. So if you own Apple, you're betting that the passive trend continues, not on the fundamental.
What's something that other people have asked you that you would have, what are other people asking you these days?
I think we've covered it well. The questions were great. Thank you all for listening and participating. This has been a blast. I thought it would be a blast, and it was more of a blast than I thought. Look, I'll do the slightly self-serving response. I've been thinking about growth forever. I co-authored a book called The Guerrilla Game back in the 90s, where we went after trying to figure out growth. Paul Sonkin and I wrote a book, Pitch the Perfect Investment, in 2017, where we came at it, and really the Italian cookie got launched there. I'm convinced Paul said it, he's convinced I said the Italian cookie from the layers. And we really started to develop that post the two post-publishing Pitch the Perfect, which now is 7 years ago, shocking to me. I spent the last 5 years really trying to link the Guerrilla Game to Pitch the Perfect, and the result of that is this market-implied value of growth, what I call value of growth. I think these tools are incredibly valuable. You know, they work really well with growth companies, but they also work really well with not growth companies. So I'm very passionate about it. Part of the reason we're doing the buy-side certificate with Wharton and Wall Street Prep is to bring those tools to individuals. I hope to have a book out next year called The Value of Growth. So you know, I think these tools, once you get your hands around, it takes a little while to understand them, not that long, but once you understand them, they are, I only think this way. I just sat through 25 presentations over 2 Saturdays at Columbia Business School at the end of the course. So I saw 25 presentations, and I'm on a mission to revolutionize the way people do fundamental analysis with these tools. The 25 presentations by students, only had a couple of weeks to work on them, were fantastic. Some growth, some deep value, some moderate growth. I think the tools are obviously self-serving, but I think they're amazing. So I encourage people to get to know them. We'd love to have people in the certificate program. One of the advantages of the Wall Street Prep and Wharton certificates is the in-person cohorts and the other programs. So this is the 3rd time I've done one with Andrew and Brett. We love, all 3 of us just absolutely love engaging with students and bringing tools to help them become better analysts and investors.
Well, fabulous. I think that's probably a good place to, you know, as people say, put a pin in it, and we'll maybe pick things back up. For those interested in learning more, there will be upcoming info sessions. I think that about wraps it up. Thank you very much, everybody, for joining, and hope to welcome you to the program.
Andrew, thank you very much for helping me manage this. I really appreciate it.
You got it.